Non-farm employment has grown sharply over the past decade. A large section of villagers has moved away from farm jobs over the past 2 decades. The growth in non-farm jobs accelerated between 2004 and 5 and 2011 and 12 largely because of a massive construction boom, which generated new jobs for unskilled laborers. The share of horticulture in agricultural output has spiked. Horticulture, which includes flowers, condiments, and spices, accounts for nearly a third of agricultural output and is a key driver of India's agricultural trade. Horticulture offers higher returns to farmers. Growing non-farm job opportunities in villages and growing diversification within farms have helped raise rural incomes and living standards over the past decade. The growing commercialization of agriculture has led to a more intensive use of almost all inputs, including labor, further pushing up wages. Rising incomes have reduced poverty. Rising wages boosted the purchasing power of those at the bottom of the pyramid and has led to a sharp fall in rural poverty. The dramatic fall in poverty ratios between 2004 and 5 and 2011 and 12 was largely because of the sharp decline in rural poverty. The improvement in farms is also reflected in lower suicide rates. A decade ago, farm suicide rates were the key drivers of India's high rate of people killing themselves. However, farm suicide rates have fallen below non-farm suicide rates over the past few years. This holds true even after adjusting for underreporting by states such as Chhattisgarh and West Bengal. The moneylender's grip over the rural economy. The burden of debt from non-institutional sources is typically high because of the exorbitant interest rates. As much as 69% of all non-institutional finance is given at interest rates of 20% and above. Farm credit has grown sharply. The high dependence on non-formal sources of credit has persisted despite a sharp increase in the credit intensity of agriculture. Over the past decade, agricultural credit as a share of agricultural gross domestic product has risen exponentially. Bank credit is not reaching small farmers. Although aggregate credit intensity of agriculture is rising, small and marginal farmers, who make up 85% of rural households, have not benefited much. Economist R. Ramakumar and Pallavi Chavan pointed out in a 2014 research paper. There has been a sharp fall in the share of long-term credit in total agricultural credit over the past 2 decades. Subsidies rather than investments dominate public spending on agriculture. Rising subsidies, which offer short-term relief but do not help long-term growth, have crowded out public investments in agriculture. GFC in the charts refer to gross fixed capital investments in agriculture by the government. Productivity growth has been anemic. The absence of adequate investments has hit productivity growth in agriculture. Annual growth rates in food grain productivity have steadily fallen since the first decade after independence.